Good afternoon, everybody, and welcome to this webinar, one of the first that EasyEquities is doing in the year 2023. And I think if, like me, the year has started with a bang for you, this is a great opportunity to sit back a bit and relax, as it were, and get some real information from an industry expert to help us with our investment decisions. Markets are proving to be interesting, and so we can all use a lot of help in making decisions. I'm joined today by Duane Gilbert, who is, as we said in the invite, one of my smartest colleagues, and I'm delighted that Duane's agreed to do this. So welcome, Duane, and it's great to have you on this webinar.
Thank you, Carl. Very, very kind of you, and I'm excited to be here.
And yeah, so I've had some experience with Duane, both eating a steak with him. As you can see, the man has got a healthy appetite. He's a superb sportsman as well. And he's torn between eating his steak and talking about investments because that's his passion. And before we get into it, Duane, I want to know, maybe you can just tell us a little bit about where you come from, your qualifications, and how long you've been doing what you're doing.
All right. I've spent my whole career in the investment management industry. I've started about 12 years ago. My hair was a lot thicker on the top when I started. And I've worked at various boutique asset managers and a few multi-managers as well. And yeah, this is all I know, all I love, and I'm very passionate about managing retirement fund savings.
Excellent. So we're going to get right into it, Duane. Often it's hindsight is perfect science, as they say. But I'm keen, as we kick it off, for you to explain to us why the investment markets performed so poorly in 2022. I mean, what went wrong?
All right. To understand what happened in 2022, unfortunately, we have to go back to 2020. I know it's a year we'd all like to forget, but it's very important for what's happening in the investment markets at the moment. So after the COVID pandemic started and governments around the world had to put their economies into lockdown, at the same time as they implemented the lockdown, they implemented massive stimulus programs, fiscal stimulus and monetary stimulus. I know a lot of you are aware, or all of you would be aware of Cyril Ramaphosa's 500 billion rand stimulus package and the SARB dropping interest rates from 6.5% to 3.5%. But that's nothing compared to stimulus packages from the major economies. The US government spent, it's estimated, about $5 trillion during 2020 in response to COVID. The interest rates went all the way down to 0.25%. And the central bank, in an effort to put more, it's called quantitative easing, to put more money into the economy, they start buying up all the bonds on the market, and they effectively injected an additional 4 to 5 trillion into the market. So it's massive stimulus. So that was the response in 2020. And obviously, after that, we had the vaccines come out and the lockdowns were reversed. And governments had an opportunity in 2021 to pull back the stimulus. But because we were facing unprecedented times, they left it in a bit longer than they should. And so we went into 2022 with fragile growth, but excessive amounts of stimulus. And then what happened is, on top of that, we were hit with two major shocks. The first shock is obviously the Russian invasion of Ukraine. That's, besides damaging global growth, it also added to inflationary pressures through commodity shortages and oil shortages. And you also had China. So China did two things. The first is they introduced quite late a strict zero COVID policy, which meant that anywhere they identified even a few cases of COVID, they shut down major cities, port cities, tech hubs. And so that contributed to supply chain disruptions and slower growth. So now all of a sudden in 2022, you get these additional two major events pulling down on global growth and adding to inflation. So central banks had to react very quickly. They had to rein in their balance sheets quickly, and they had to raise interest rates quickly. And as a result, markets felt the pressure. And on average, investment markets, equity markets were down 20% across the board. It's only really South Africa, believe it or not, that had a decent year in 2022. And there's a few reasons for that. The first is when governments were stimulating the economy and equity valuations were increasing, we didn't really benefit from that. So because we didn't benefit from that, we weren't hurt as much when the stimulus was withdrawn. Secondly, brand weakness over the period, obviously not great for the economy, but 70% of our earnings on the JSE come from offshore operations. So, optically, it boosts the profitability of the JSE. Thirdly, and quite perversely, the commodity shortage as a result of the Russian invasion of Ukraine, that actually benefited us because, things like platinum, for example, now in short supply, and South Africa is another producer. So the commodity shortage benefited our resources sector. And I'd say finally, before that, towards the October last year, China suddenly and abruptly stopped their zero COVID policy. So that obviously benefited our resources sector and the likes of NASPERS even more. And finally, South African equities are cheap in terms of global standards when you look at global PEs, PE ratios. And sometimes when cheap assets recover or rally, they start to gain momentum. So that's really what 2022 was about.
Thanks very much. Yeah, and I mean, there's lots one can unpack there because many people would argue that, yes, South Africa benefit from the resources that you spoke about, but because of our damaged infrastructure and load shedding, etc., that perhaps we didn't capitalize enough. So it's always interesting to see the positives and the negatives from these trends. Now, I mean, I'm invested, so disclosure on that and some of your products on the Easy platform, the Rise bundles, and you did well for me in this turbulent year. What were the reasons for that? Was that luck or what?
So I think, broadly speaking, we did quite well to identify the trends that we spoke about early. So ahead of pretty much all of our peers, we de-risked our portfolios. And what that means is that we reduced our exposure to global equity. We started rotating from cyclical sectors into defensive sectors. We started having a preference for domestic assets over global assets. And very importantly, we held a lot of cash. Because in a year like 2022, when there's a sell-off, something sell off too much. And, we were presented with some opportunities to pick up some fixed income assets quite cheaply as well, which contributed to performance quite a bit. But, just to make one thing clear though, Rise Easy Asset Management, we manage retirement fund savings, so I don't want to give anybody the impression that we're trying to chase returns by calling the market environment. Ultimately, we believe in keeping clients invested and having market exposure that's appropriate to their risk profile. So for our younger investors, we would like them to be more invested in equities, and our older investors, we'd like them to be more invested in fixed income. But we are very passionate about risk management. And, if the environment calls for it, we will de-risk our portfolios to a degree. And we think that sort of reduces the volatility of our returns and improves long-term performance. So what you'll find in a year like 2022, which is a bear market year, we tend to do quite well relative to peers.
Yeah. And so 2023, what is the outlook? I mean, what are you guys looking at? What are you investing in? How are you going to be making us money? That's what we all want to know. Give us the right answers.
All right. So 2023 started off with a bang, I would say. And a lot of it had to do with China. So investors are becoming very optimistic about China and the idea that now that the lockdowns are over, that they're going to go back into this growth phase. I think markets are sort of overreacting because remember, we had 3 years of very strict lockdowns, and now we've only just ended the lockdown policy, and there hasn't been commensurate stimulus measures. And that's not talking about the damage that, all the clampdowns on the private sector had. So the property clampdown, the tech clampdown, private education, etc. So, there's still a lot of damage that's been done to the economy. So I don't think that this news is going to translate into increased infrastructure spend, which is, I think, what everybody's very excited about. I think, yes, you will have some pent-up consumer demand being released, similar to the developed world or the rest of the world when we came out of lockdowns and people started traveling more and eating out more. So you will have some of that, but that's more on the sort of the luxury goods side, not so much resources and infrastructure spend. So China aside, so look, it's still early days. You have to watch China, and one thing about China is they're not very transparent about what they're doing. So it's hard to take a view and stick to it. You have to always watch what they're doing very closely because, policy can take a U-turn and, nobody will even give you a heads up. So it's something we're watching closely, but for now, I think it's too early to get excited. Aside from that, I think the macro environment is still very unsupportive. So you've still got an environment where inflation is high and central banks need to fight inflation. Growth is low. If you look at global PMIs for the major economies, they're all below 50 and trending downwards. This conflict between Russia and Ukraine, that's not supported. That could escalate. It's pushing parts of Europe into recession. And like I said, there's no meaningful growth coming out of China yet. So in this environment where, sort of growth is weak, but and stimulus is being withdrawn, it's very hard to get overly excited about global equities. So at least for the first part of the year, we remain conservatively positioned. Even though everything I've spoken about is very well known, I don't think it's in the price yet. I think global equities are still 15 to 20% too high on average. And I think a lot of that has to do with the market thinking that the Fed is going to pivot on their guidance, their rate hiking guidance. And I understand where they're coming from, because since 2008, where there was, the first global experiment of massive stimulus, every time there was a hiccup, every time there was a bad jobs number, the Fed always, stepped in to support the market. But the difference between that time period and now is inflation wasn't a problem then. Inflation is a problem now. And, just using the US as an example, but also, the US is the most important economy in the global sense. Their unemployment, I think, is running at about 4% or 3.5%, which is below their long-term average of 4%. And the inflation is running at 4%, which is above their target of 2%. So at least for the time being, we expect them to focus on their fight against inflation. So I think, we're going to see further downside this year. And I think that, 2022 was a sort of gradual slide downwards in equity prices. I think we could have a more aggressive sell-off this year. And I think that's both terrifying, but also exciting because, if you all think back again to COVID, when there was that massive sell-off in March, April, there was opportunities to pick high quality stocks like SA banks, 15, 20% below, their fair price. And so I think there will definitely be some big opportunities presenting themselves as the year progresses. I can't tell you where they are. We'll have to wait and see, but I think it's prudent to hold some cash to take advantage of that. And, past that, it's hard to say because really after, if something like that plays out, I don't know how the Fed will react. I don't know, whether inflation will be under control at that point, or there's too many unknowns. So it's only, yeah, I mean, past this first part of the year, there's a lot of uncertainty. We'll have to wait and see.
So Duane, most of your life, I know, spent dealing with institutional investors, large companies, large funds. Many of the people on the webinar are, work for those companies, make decisions at those companies, but many are retail investors like myself. And so I want to explore a little bit. I mean, somebody like you, how much of your time do you spend reading and watching news and political affairs? So, with President Biden doing his State of the Union address today, President Ramaphosa, our State of the Nation tomorrow, are these things that you think genuinely impact and that you follow and then make calls on it? How much do you engage with that, and how important do you think it is for retail investors to engage with these?
Yeah, I mean, that's a great question, actually, because I think there's a lot of noise out there. And, especially if you watch a Bloomberg screen all day, you'll think the world is coming to an end every day. But, the reality is a lot of it's noise, and you need to focus on sort of the medium to, I wouldn't say long term, but the short to medium term trends and, what's driving that. And, yes, those things, the markets do react to, any of Biden's speeches or the Fed speech, for example. But, those reactions are usually quick and a lot of the time nonsensical. And sometimes in hindsight, you think, oh, I could have made 4% on the stock if I had. But the reality is that trade occurred very fast, and a lot of the time it moves the opposite direction than what basic economics would tell you. So I wouldn't get too caught up in the day-to-day trading. I think first and foremost, the stocks that you hold, you need to have a fundamental investment case, right? You need to, understand where their profits are coming from, how much debt is on the balance sheet, how they plan to grow their profits, who the people in charge are, all those important fundamental analysis things. But it's very important as well to understand the macro environment in which they operate. So like I said, try not to chop and switch your portfolio too much based on day-to-day news, but certainly it's sensible to be cognizant of what's happening in the macro environment when you make decisions.
And Duane, based on some of the comments you've made, particularly around South African equities, and I think it's a fascinating point that many of us forget, that 70% exposure. It's the wrong terminology, but that 70%, that the shares held on the JSE, we've got 70% offshore exposure. I mean, it's really interesting. Do you think there's still opportunities within the small and medium cap, and particularly Rise, and how you positioned your portfolios, going forward in that sector? Yeah,
so I think one thing that's very exciting about the South African market is the small and mid cap space. It's one of the few places I think you can find some genuine gems if you put in the work. And especially if you're smart enough to identify a potential takeout target, there's good returns to be made. And it's honest returns. You do your fundamental analysis, you understand the company, and then you take a position. It's not gambling on where the exchange rate is going to go. So I mean, we are overall our view on equities at the moment is that we feel on a long-term basis it is still cheap relative to global equities. So we want to be long our domestic equities. The valuations are attractive, but after they've rallied in a straight line since October, they're feeling a bit toppy. And I think two things: as the market starts to realize that China infrastructure spend is not really coming through, and as the global environment starts to deteriorate further, I think we could be in for a pullback on the local exchange as well. But like I said, on a longer term view, I still think our equities are cheap, and I think there's some real gems in the small and mid cap space. So we have a sizable position in the small and mid cap space, and the idea is there we buy those stocks and we hold them. And so yes, when we make macro views, we do trim our overall equity, but we try not just to touch our core holdings, our long-term plays.
And I think for me, it talks a lot to the obvious principle of diversification. So, whether you've got a 100 Rand portfolio on Easy or 100 million Rand, as some of our clients do, it's all about the diversification. So, keep some in cash to take part of these opportunities, particularly if that pullback happens quickly, as you suggest it might well do. Stick to the shares that you bought for good reason, because you value their strategy and the people that run the business. And then look for opportunities in some of these small and medium caps.
Yeah, sorry, I know I do sound quite negative, but I don't mean to scare anybody out of investing. I mean, shares, statistically, that's your best bet at producing long-term returns. And,
it is, yeah, sorry, I'm interrupting you there. You were going to say, just finish. Sorry, I interrupted you.
Yeah, so it is your best bet at superior long-term returns, and it's important as a long-term investor. So, but when you're faced with an environment that we faced with now, I think it might make sense to maybe pull back on your cyclical exposures, maybe increase your exposure to more defensive sectors, hold a bit of cash, and like you said, stay as diversified as possible.
Do I just give us a couple of examples when you say cyclical and the defensive? Give us some examples of those, please.
Yeah, so I mean, with your cyclical, well, with your defensive sectors, traditionally it's more, sort of healthcare and consumer staples and utilities, whereas your cyclical sectors are more your luxuries and your energy stocks, your resources and commodities, the things that are very sensitive to the economic outlook. And so when you're in an environment where, the economy is firing, global economy is firing and things are growing, you can do quite well into getting into those cyclical sectors quite early. But when you're in an environment where, the global economy is not doing so well, you tend to be better positioning yourself more defensively, and also focusing more on quality, having, good quality of earnings revenue. Yeah.
And for me, I think we've seen with EasyEquities, we often get asked, what must I invest in? And as much as we're really focused on not providing advice and saying to people, it depends on your own age and your circumstance. Two things for me over the time that I've been involved with Easy that's very true is do your research. So, whether you use, we've got research.easyequities.co.za, and some of my colleagues who run that are on this webinar, and they do that really well. Whether you check that out, whether you read Financial Mail, read The Finance Ghost, Just One Lap podcast, there are a wealth of resources, but do the research and then make up your own mind. Nobody's got the golden bullet. If they did, or the silver bullet rather, if they did, then you'd all be billionaires. And so I think it's really important people do their research. And the second thing for people who either don't have the time or the inclination to do that is to look at the experts. And that is one of the reasons that I love providers like Rise, and there are a couple of providers that I enjoy, because this is what you live and breathe. So you guys, invest based on this research. But I'm keen to explore a bit more about impact investing, because this is something that everybody's talking about, Duane. And, are there opportunities for retail investors to do impact investing, add that to our portfolio? What is impact investing? Is it, something that's in Rise portfolios? Are you growing that? I think if you just talk to us a little bit about those opportunities, please.
Yeah, so impact investing is something I'm personally very passionate about. When you look at the retirement savings market in South Africa, I think it's estimated to be over 4 trillion Rand. But if you look at a typical retirement fund, and I'm not bad-mouthing anybody, because our funds are also positioned similarly, but straight away we take 20, 25, sometimes 30% offshore, depending on what the regulation allows. and that money is gone out of the country. Then we invest another 40 to 50% on the JSE, and like we spoke about earlier, 70% of that money is gone. So, you know, when you do the maths, there's not a lot of reinvestment actually happening in the economy, which is unfortunate. And, you know, obviously, first and foremost, our responsibility is to generate returns for our portfolios and for our members. We're not, you know, we're not a charity. We can't use retirement fund savings to do charity work, unfortunately. But I think there are opportunities to actually invest in the economy and get good risk-adjusted returns. And specifically in our portfolios, we've identified 3 focus areas. The first is renewable energy infrastructure. And I don't think I need to explain to anybody why that's important. You know, the one aspect is obviously the transition into net zero economy. But even more important than that is we need electricity because, you know, the damage it's doing to our economy and, you know, unemployment rate it's devastating. So, you know, we see a few opportunities in the space. The first is to participate in Eskom's REAP program and supply electricity back into the national grid. And get, you know, government guaranteed return that's reasonably attractive. The second is, you know, private PPA agreements, so power purchase agreements. And what you see, especially in this past year, is a lot of corporates now realizing that they need to actually get off the grid and have some kind of independent solution. But and you know, there's various models. The model we like is the tariff model, where you install the infrastructure, the solar panels or the wind turbines and the storage, and you tariff the user, and you can get quite attractive tariffs. And you might not realize it, but that, you know, that actually has a big impact on electricity consumption overall, because now as you get corporates off the grid, it leaves more electricity in there for consumers. So those are really the 2, I would say, big opportunities on the renewable space that we're trying to take advantage of. The second area of focus that we have is affordable housing. So controversial view, but I'm not a big fan of listed property. The listed property, you know, predominantly office space and retail. And I think, you know, office space, you can see the vacancies in office space with people working from home. And, you know, even with retail, firstly, people are starting to shop from home. But secondly, tenants are fighting with a, you know, weaker consumer and, you know, high electricity prices, etc. So it's a tough environment for listed property, I think. Very excited about residential property. And specifically our area of focus is affordable housing. So the idea there is we try to build gated communities that are sort of strategically placed near city centers. So a lot of people spend a lot of money to get to work every day and a lot of time taking 2 taxis and a bus, and they don't have enough money for a car. They don't have enough money to buy a big house in, you know, in the city. So the idea here is to get property that's reasonably close to a city center, but it needs to be close to transport nodes. It needs to be close to shopping centers, schools. And, you know, we offer the highest levels of, you know, just the design with security and, you know, the little bits of extras, daycare, those sorts of things. And it becomes an affordable solution for sort of 2 working parents with a child, 2 children, that they can rent an apartment that's safe and allows them to get to work, allows the kids to get to school, and they're not spending, you know, the kids are not taking trains to school. And yeah, I mean, the demand for that is tremendous. So again, I mean, we're able to get decent rental yields out of those properties, more attractive than the rental yields on listed properties. And you get a real sense that you're doing good as well. And finally, what we focus on is the commodity trade finance, and specifically commodity trade finance, but it's really loans to small businesses, if you look at it that way. And the loans are fully secured against the inventory.
Yeah.
So the problem, sorry, you say something?
No, I was just agreeing because I think it's a fascinating investment and very worthwhile.
So the problem we have in South Africa and globally is with the banks is because of regulation, and sometimes because they're lazy as well. They won't lend you money unless you don't need the money. So, you know, you need to have a very strong balance sheet to access financing. And then what happens is the only people who access financing are the large corporates who then just access financing to leverage their returns. They don't access it to actually, you know, do any new economic activities. And then you get the smaller guys who have good deals and not bad balance sheets, but, you know, it's not as strong as, you know, the bank would like to see. And, you know, those guys get left behind. And what's nice about it is we focus on deals where there's, you know, actual commodities underlying the deal. So it allows us to warehouse the commodities separately and have full security in our deal, because the commodities are effectively their security. So, you know, I wouldn't say it's a risky venture. It just requires a bit more work than I would say banks are willing to put in. So those we focus on.
Thanks, Duane. And before I ask you about petrol price and interest rates, to tell us what's going to happen there, I two things. I agree with you around properties. Also, not my preference, and it's one of the reasons I do like EasyEquities, because of the diversity there and liquidity through the auctions. And we're paying dividends in a week or two. And Ronald, who works with us there, you know, reminded me we're paying just over 2 million in dividends in this next round. So every, you know, couple of months we're paying millions of dividends. So, you know, I like that. And then, as we mentioned, Charles, our CEO, in our results presentation, our lending product is launching now in the very near future, and that is just a way for people to access cash using their portfolio security. So really excited about that. But tell us about interest rates going up, coming down. What's going to happen?
Yeah, so fortunately, interest rates seem to have peaked. So importantly, with the SARB is not like the Fed. The Fed will give a long projection of what they're going to do. Everything the SARB does is very data dependent, and you can access their quarterly economic projection model to see how they're thinking. It's on their website. So now that inflation is rolling over, but bear in mind, inflation is still high. It's not in the, you know, the band that we need it to be. But now that it's rolling over, I think we might see another 25 basis point hike. And then, you know, the SARB will pretty much hold it there for a period of time. And again, we'll just have to see how the year plays out, because everything is data dependent. But when you look at what, you know, the markets are pricing in, if you look at the forward rate agreements and swap curves and money market instruments, they're basically pricing in, you know, another 25 basis point hike, like I said, and they see it staying there for the rest of the year, and maybe towards the end of the year, starting to ease a bit. So that's pretty much the outlook for interest rates.
And Duane, the next one is around petrol price. I want to know if it's going to go up or down. And I also want you to tell me why. When the petrol price goes up, so do the food prices. And when the petrol price comes down, the food prices don't. It makes no sense to me.
Yeah. They say what inflation is very sticky on the downside.
Yeah.
Look, I mean, I will give you my view, but bear in mind, you know, the Brent crude price is very hard to predict. You know, there's a wide convergence of factors that actually affect the price. But you know, the way I see it is, you know, if you go back again to sort of the Russian invasion of Ukraine, you know, the price spiked all the way up to $120 a barrel, thereabout, and that was in anticipation of sanctions, which actually played out as expected. And then the price started steadily falling over 2022, and now it's, I think, $76 a barrel, thereabouts. And that's just been because of global growth. So remember, everything comes down to supply and demand. Global growth is really the demand side of the equation. And as that global growth has come down, so has the oil price come down. But I think, you know, when you look into 2023, China is very important. So again, I say it's very hard to say what the outlook is for China for the full year. But even if all they do is reverse the COVID policies, and you see that pent-up demand being released the same way that it was in the rest of the world after we came out of lockdowns, then you'll see, you know, quite a bit of traveling, quite a bit of economic activity, of spending, and you know, that should put upward pressure on the price of Brent crude again. And you know, it's very hard for me sitting in Cape Town to tell you exactly where the price should settle, but you know, the credible analysts that we follow feel that, you know, the price could drift back up to $120 a barrel. Bear in mind that all those sanctions that were put on Russia are still in place. So, you know, global output is about 700,000 barrels a day lower than what it was before the invasion. So what that means, well, remember, there's two sides, there's two determinants of the petrol price. Well, there's actually three. It's the levies is the third one, but it's the price of Brent crude and it's the exchange rate.
Exchange rate, yeah.
So look, I mean, for the time being, we are quite negative on the exchange rate. You know, the way, especially in the sort of the global environment that we just painted, I think there is some downside to come. But when things settle, you know, over time, the exchange rate tends to go towards like a fair value, purchasing power parity value. So I think if you look at a full year estimate and on the rand, I would suspect you'd probably see it come down all the way to 16. But in the interim, it could spike up to 1850, 19. So, you know, with those sort of parameters, I think the petrol price could get anywhere to 27 Rand a litre to 31 Rand 50 a litre.
Cool.
Yeah.
Right. You drove me to drink earlier and you're sending me there again. So I think two more questions. Load shedding. How's load shedding going to affect us?
Yeah, sorry, you should have asked an interest rate question second.
Are we as load shedding I mean, it's a stupid question, going to carry on impacting us? The answer is obviously yes, but in what way do you see it, you know, impacting markets and investment portfolios? I was popped into Woolworths between two meetings today to quickly buy a sandwich for lunch. And it's the first time I've been confronted by this, but I know that, you know, I've read about it. But I walked in and everything was empty, because the generator in the shopping center failed. There was load shedding, and so they couldn't do the cold storage. So all the fridges and freezers in Woolworths were empty. And I mean, that's obviously got to have an impact on retailers' costs, what they charge, their profits. So am I selling out of Woolworths and Pick and Pay? I was just getting excited about the retailers, or what am I doing?
Yeah, so I'm glad you said that, because I think one of the problems we've had, and hopefully it's changing now, is corporates have been very slow to get off the grid and come up with independent solutions, you know, solar panels and storage. I mean, ironically, you know, you go to Namibia, they don't even have load shedding, but all the shopping centers have solar panels. So it's a bit disappointing, but I think it's part of a larger problem that people aren't really reinvesting in the economy. But yeah, I mean, the bottom line is, so, obviously we know equity, the Aussie is all-time highs. I think the rally we had on the back of China, so it's concentrated in resources and NASPAs and process, I think that's hiding a lot. But I also think it's caused a lot of positivity. So you have investors focused more on this idea of growing China or being reflected in the share prices than the deteriorating domestic conditions. So I think this year, as you see the earnings reports start to come out, I think people are going to have to wake up to the fact that load shedding is a big problem, and you're going to see it more in the domestic facing counters. Things like the retailers, as you mentioned, the property companies, they will be more hard hit, and obviously the guys with more offshore earnings will be a little more resilient, but even they have some domestic operations, right? Or the production is domestic or something, so it does affect them. So yeah, I mean, on the equity side, I think there is some pain to come. I mean, it surprises me a lot that equity markets are this resilient in the face of the kind of load shedding that we're seeing. But you see the currency market and the bond market behaving a bit more rationally. So you're seeing the rand drift upwards on the back of load shedding, and the bond market is taking it particularly hard, because not only does it increase the country risk premium, which is a component of what determines bond yields, but it also because of load shedding and this reduced GDP and reduced taxes, it means that the government's going to have to issue more bonds to compensate. So the yield curve is starting to reflect in an anticipation of higher supply. So just to bring it back to our portfolios and how we positioned. So in 2022, we took quite a chunky position in bonds. We got some really decent yields because we held cash and waited for a sell-off. We were expecting a bit of a rally, which we didn't really get because domestic issues deteriorated, not only load shedding but also the politics. So, but still, I mean, we sold it at good value, and the nice thing about bonds is you receive coupons. So you get a 12% coupon out of a bond that you hold for a year. That's a good contributor to return. And equities, it's feeding into our decision to just be patient and stay underweight relative to our peers. So we are taking a little pain on that position relative to our peers, but I think we're making it up on our other positioning. But I think it's more prudent to just kind of wait for these things to play out and for equities to correct before, getting a full allocation in.
Yeah. I mean, you obviously talk mainly from the institutional space, but bonds is something that I think is poorly understood by many retail investors, certainly by me. And it's also something that's not easy for retail investors to access. There's lots of stuff we're working on and lots we need to deliver, but in the pipeline at Easy is a way to find to find ways, and you're very much involved in doing this. Because where can presently retail investors, where do we access bonds? I mean, the only place we can do it is through portfolios like Rise or the like, Duane, or how?
Yeah, so I mean, truthfully, I'm very excited about bringing what you're doing to bring bonds to the EasyEquities platform. I think on the JSE and just in general to retail investors, there's very few yield plays. And what you want in times of uncertainty is to get away from investing in growth and get more towards income producing assets. So I'm very excited about that. So unfortunately, at the moment, bonds not very accessible to the retail investor. You can obviously access South African retail government bonds through the website. That's one avenue to get access to bonds. The other is really at this point just bond unit trusts, which I'm not always super excited about for a few reasons, but I won't get into that. But yeah, unfortunately, it's a part of the market that's hard to access for a retail investor.
Cool. So wrapping up, concluding with that you don't pick stocks, you're not a trader, you're not in and out. It's largely retirement funding space, looking at the fundamentals and the trends. I do want to put you on the spot. And you've already told us you don't like listed property that much. Crypto, yes or no?
Yeah. Look, so
you can't be like a politician and give me a long answer here. Come on.
Right. Yeah, from an institutional perspective, I will say no. So I don't think crypto has a space in retirement fund portfolios. Ultimately, anything that we invest in, needs to be backed by real earnings and real growth in earnings, because that's a prudent way to invest retirement capital. So we've never even considered crypto in our investment portfolios. On a personal note, it's a maybe. I made a little bit of money, not a lot, playing around with crypto. I still can't tell you, exactly how it happened, but it's it's one of those things. Hey, it's for every winner there has to be a loser. So.
And I think it talks to diversification again, and diversification is, it's not equal parts of your portfolio and property, crypto, unit trust, etc. It's a small percentage. So, I try and learn from my Easy Crypto colleagues a little bit about crypto. I don't understand that much about it. I've been invested for a long time, so my crypto portfolio over a long period is down, but I fundamentally believe in the work that they're doing there. So I bought up, and my 1 month return is over 30%. So, it also is that, if you believe in something that you invested in, Naspers is a good example as well. Naspers took a big dive, lots of people sold off, and look at the money that's been made in Naspers in the last bit. So, I want to emphasize the point. People need to do the research, really, buy something consciously. Don't just go for the hype. Understand why you're doing it. Talk to the people involved. Otherwise, listen to the experts. Like you, Duane, and I want to thank you for spending time with us today. We can access your products on the Easy platform. Maybe you can just give us a quick, are they simple? I mean, I think they link to inflation plus percentages. Maybe just briefly explain how those work, please.
Yeah, so we have three sort of house view portfolios. And again, this is more sort of an institutional norm where you have a CPI plus 3, a CPI plus 5, and a CPI plus 7. Typically, the CPI plus 7 targets CPI plus 7 over a 5 to 7 year period. CPI plus 5 targets CPI plus 5 over a 3 to 5 year period, and CPI plus 3 is shorter than that. And the idea is you optimize the mix of asset classes to achieve that target, and that's something you can do because we know what the historical correlations are between the asset classes. We know what the risk premiums that are built into the asset classes are. So it's quite an academic exercise, really. And the idea is that, as a younger investor, you can withstand, you have that, 5 to 7 year horizon, then you go for the CPI plus 7 and you ride out the volatility. Obviously, within the portfolios, we try to manage it, but again, we don't stray too far away from the appropriate risk profile. And if you're older or you need the money sooner, then you opt for a lower risk, sort of lower return type portfolio. That's really how we do it. We're all about absolute returns, not about chasing the market, not about trying to outsmart the next person.
Yeah. Thank you so much for sharing all of those thoughts and ideas. A reminder, research.easyequities.coza. There's some bespoke research there, but also links to useful other people and publications that write about the topics we all need to follow to help us make better investment decisions. And I wish us all well. I think it is going to be a bit of a scary year, but if we ride it out, which I'm confident we will, because I've always said that retail investors are super smart, I think we're going to be in the money. So Duane is used to talking to institutional investors, which is why he wears a suit. But we are going to get him the next time he shares some pearls of wisdoms for retail investors, to be less circumspect and to nail his colors to the mast and give us a few shares. Secondly, he's going to be wearing his not spandex. What is it? Duane is a brilliant cyclist, so he's going to be in his cycling gear and far more relaxed, talking to the retail investors. We're much nicer and much smarter than the institutional guys, Duane. So you don't have to dress up for us.
All right.
Thank you very much for sharing all your thoughts, and good luck with what you guys are doing at Rise. Thanks everybody for joining us. Wish you well with all your research and your investment, and may we all make some profits in the coming months and years. Thanks very much. Cheers.
Thank you.